Everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to do we're going to look at Twitter, see what people are talking about, see what people are sharing, and obviously I'm going to interject my financial opinions as we go. So let's dive in here, see what's going on. If you want to follow me at finding_finance on Twitter, or you can join our community, finding-value.com. We do have a discount coupon code called discount for a discount on the monthly and yearly memberships. Looking forward, U.S. national debt has been growing faster than GDP for nearly 10 years. However, U.S. national debt is now growing faster than GDP by its largest margin in history. As of 2 weeks ago, the national debt crossed 33 trillion, nearly 124 times as big as it was 70 years ago. Over the last 2 weeks alone, we have added an additional 450 billion to the national debt. Currently, the debt to GDP ratio sits at 120%, just below its 135% peak in 2020. Truly mind-blowing numbers. Now, here's the problem, guys. As your national debt starts to increase at a faster pace than your gross domestic product, think of this as your debt and think of GDP as your income. We are going more and more into debt, and it's becoming less and less sustainable. This is the problem. So if you look at the difference here, and I was listening to, I think it was Raoul Powell, he had an interview, and he said all of this difference between the national debt and GDP is going on the Federal Reserve's balance sheet. So I pulled up the balance sheet just to show you guys. And you can see here that it looks like it was increasing in 2000. I don't know. It was coming up a little bit, but not really too much. So when we crossed about 2012, that's when things really started to go crazy. Here's 2012, and this is where things go a little bit crazy here. And the bank balance sheet really blew up. So what he was saying is this difference here between the national debt and GDP, and it's not just the GDP, it's the difference between your income and then the interest payments on the debt and whatever that difference is has been working its way to the balance sheet on the total assets balance sheet of the Federal Reserve Bank. So the crux of the problem I think that occurred here, and this is me just thinking about it for a while, is I'm going to use a little bit of what he said and then a little bit of what I think. He said that in 2008, when we had the great financial crisis, we had basically a debt reset or debt jubilee where they lowered interest rates to 0%, printed a bunch of money, bailed out a lot of stuff, et cetera, et cetera. Ever since then, we've been in a recovery phase of real estate. Now, this is my opinion, okay? Been in a recovery phase of real estate, which is low inflation and low interest rates. So everything was kosher for that time frame because of the low inflation and low interest rates. Now that we've entered an expansion phase of real estate, where you get more inflation from fractional reserve lending, more lending coming into the system, that lending and credit growth is pushing yields higher, along with the stimulus that they had done. So it's the combination of those two things uh, pushing inflation and then eventually pulling interest rates up with it. And I think that's going to cause a potential debt crisis maybe at some point when the national debt and GDP really start to diverge from each other, like they are right here. You can see the divergence between the two lines has never been greater. So it says the debt is now growing faster than GDP by its largest margin in history. So I think that the expansionary phase of real estate is pushing us into a debt crisis, perhaps. And the only way that they can fund all this is by continually putting more on the balance sheet. Now you can see on the balance sheet here, we have declined quite a bit to the downside. They're basically unwinding it. But you've seen what happened to bonds when they start to unwind it and the interest rates. The interest rates really push into the upside. So it's an interesting setup, and I'm not sure how Powell gets out of this unscathed. I think that the pressure will build in bonds at first, and then right after the pressure is going to build in the currency. And I think if we get a lowering of interest rates here soon, I think the dollar is going to go down. That's my guess. And they're still stuck with an increasing national debt and that which is going to outpace their income. And whenever your debt outpaces your income, it's a matter of time, guys. Then it's a matter of time. And I know they have an infinite money printing machine. I get it, but I think this commodity bull market's going to be big because of this dynamic. So looking backwards, just to recap something, the commodity booms before were credit driven and demand driven type events through the real estate market. It was the demographic getting larger, going into home buying years, expanding the credit, buying a lot of stuff. That was all inflationary. And every time we had these moves, the credit expanded faster than the supply of the commodities. But there was an ample supply of commodities in the world, and it could rectify itself rather quickly. This here, this is a whole different beast in terms of where the inflation's coming from because GDP was always outpacing the debt, and now it's reversed and had crossed in the 2010s. If we hit supply constraints in energy or other materials, we're going to see some, I think, ridiculous pricing. And this is the driver of everything. This is going to be one of the massive drivers of it. We still have a demographic, the millennials coming to home buying years, but this is layered on top of it. This is a bigger cycle. And we could see a lot of inflation coming from this dynamic with the national debt and the GDP not performing to it. The way that they say that is out of this, just to let you guys know, their opinions are artificial intelligence is going to increase productivity to increase our GDP per capita and get us out of this is one of their ideas. Another idea is, and why they're going after the green revolution so hard, is they're trying to reduce the price of energy. Because if you can reduce the price of energy, you can effectively increase your gross domestic product because it's a cost, one of their input costs. I think they're trying to do everything they can to increase GDP. So they're trying to bring in more people through immigration. They're just opening the borders and letting people cross. I think that's one thing that might be doing it. Um, they're trying to do AI and productivity gains, and they're trying to decrease the energy input costs. And I think that's what they're trying to do. That's my guess. Whether that's right, wrong, or indifferent, but that's what they're trying to do. Um, we've got some interesting setups here too. I've been watching. I've got copper here, which is kind of, is this going to break out to the downside? Unknown yet. We've got a squeeze coming up where we're breaking to the upside here on the gold to silver ratio. Now, these haven't closed on a weekly basis. They're just starting to break out. We're also topping on the 2-year, 10-year yield. And when we uninvert the curve, when the curve it inverts here and then we come back, that's generally where a slowdown could occur. So I'm watching it, and generally during that time frame, gold and silver do very well. So that might be bottoming out. It might not be. It all depends. We're playing a game that is rigged, and we don't know what the Federal Reserve is necessarily going to do. They say that they're going to hold the rates high. That's going to decline or decrease the liquidity in the system. but we could hit a problem where they have to basically hit the gas again to some degree. They hit the gas again, that's when the money is going to go into the system and raise everything up. It's going to increase prices of everything. So I think the game here is collect assets and just hold on. Collect assets and let that debt be a tailwind behind your commodity assets. But you're gonna experience a lot of volatility here in the short term. I think we could see some downside if the markets get spooked or get fearful or there's an event that occurs. It's very possible. It's very hard to predict as you're trying to predict what other individuals like the Federal Reserve are going to do. So here's Grady, and I go through a little bit of Grady's posts. Some of these are pretty good. He says a historical massive asset paradigm shift is in the making. It's away from equities, bonds, and paper assets. As said now for 3.5 years, the commodities bull will be the greatest opportunity in your lifetime. The next up leg is incoming, get educated. So why is it the greatest opportunity of a lifetime? Because of this. The national debt outpacing GDP puts the Federal Reserve in a bad situation where it's going to be inflationary. We're still going to get the boom bust cycles, but I think they're going to be amplified by liquidity being added into the system because of this difference between national debt and GDP. That difference and that inflation is going to drive commodities berserk because it's going to put pressure on the bond market and it's going to put pressure on the currency market if they try to print or do QE or do any of those stimulus packages that they've done before. So we're seeing these large patterns set up. Grady's got a good example of this where gold could outperform the NASDAQ. We've broken out, we've done a retest here of a falling wedge, and we could probably see good outperformance in the future at some point where gold outperforms the NASDAQ. That's also a sign of where we're at in the market conditions. So I do think that we could see a slowdown in gold is going to rip it if the Federal Reserve has to print more money. And I think it's all lining up for that to occur at some point here. Here's another one. The 20-year United States Treasury has not quite reached the price target for the pink inverse head and shoulders. But it looks close enough now with that negative divergence. Plus, stock market has not reacted much to its last push, really. So a turn down here looks probable, huge implications. So he's talking about the 20-year Treasury yield. The yield could turn back here, which means that yields could come back for a period of time. And then we're going to get a big blow off up leg for the last up leg of yields going higher. But he's expecting perhaps maybe a pullback. So it's the first leg, second pullback, third leg, fourth pullback, and then potentially a fifth move. And he's got yield curve control coming here, plus QE infinity as bonds then down a lot. So he's maybe wondering if something's going to occur, a slowdown, yield curve control, whatever it is. But he's got yields coming down first and then a big move to the upside. So that those yields typically are an indication of a potential slowdown. And that slowdown forces money into bonds. Then it's going to say, is yield curve control or something else going to happen where stimulus pushes it way up to a very high level? That's yet to be determined, but pretty interesting. Here's another one. It says the breakdown for this 15-year SPX to producer price index ratio chart with the back test from below is bearish the stock market. And they need to pour some QE over the Goldman Sachs chart to save it. The commodities bull is the place to be, in his opinion. So the S&P 500 was outperforming. We've broken that rising wedge. We've done a retest here, and that's generally when you get a fall in the ratio where the producer price index will outperform the S&P 500. That's good for commodities. So When the stock market cannot outperform inflation, global capital will need to move to commodities. And that's what I think will happen. And this is a big chart of this potentially breaking down. A huge false breakout or a launch pad for final Fed QE infinity blow off. Who knows? And it lies in the hand of the Fed and what they're going to do and how they're going to react. But Goldman Sachs monthly, we're sitting on top of this pattern. Are we going to do a false breakout and head lower, or are we going to do a massive launch to the upside from QE? That QE is going to come from this difference between GDP and national debt. That's one spot that it could come from. Because remember, the whole system is basically alive from stimulus and liquidity coming into the system. If they don't liquefy the system, what happens is the debt outpaces your income and you start getting bankruptcies. So that is what would cause the move to the downside of this with a false breakout. It'd all go down because you have a bunch of debt in the system that people can't pay off, whether it's the public debt or the private debt. There's a lot of debt in the system. And if you can't pay it off, that means that foreclosures and bankruptcies would occur. The way that you can cheat the system for a while or forever at the expense of your currency is to print more currency and raise the incomes and wages and all this stuff of the people to pay off all their debt. Or they raise the asset prices, which they're doing all of that when they print money. This is Eric. He says, a chart worth 1,000 words, still hated and under-owned, despite their strongest balance sheets in history and record free cash flow, soon to be meaningfully returned to shareholders. The energy sector represents, in my opinion, compelling, deep value with a catalyst on the near horizon. So he's got the relative sub-index valuation matrix, the most expensive one with the least amount of free cash flow yield and the most expensive enterprise value versus their earnings before interest tax is technology. We've got real estate, technology that's pretty high, real estate, Canadian real estate. And all the way on the right over here, this is where your free cash flow yield is way off the charts, depending on what the price of oil is. $70 oil, it's killing it at 10% free cash flow. 80s at 14, 90s at 18%. It also means that their enterprise value to earnings before interest tax are also on the cheap end. So not only is their free cash flow yield very high, they're also incredibly cheap in terms of their valuations. This is an anomaly, is what it is. I don't care what people think in terms of, well, oil is going to go away in 40 years. Okay, fine. But it's not, number one. And number two, these guys are making a lot of money. And I think they're going to continue to make money. We could see volatility in the price of oil as we ride through this. It could be commensurate with the QE that the Federal Reserve does. If liquidity tightens, we could see things tighten up in the markets. We could see oil price fall just like everything else. They go to reliquefy everything. They do QE. They do all this stuff. And then we see the inflation come back raging again. So we could see this go back and forth, in terms of the pricing and their free cash flow yields. They are paying down debt, and a lot of these companies are probably going to come out of debt here, and they're going to be debt free. So pretty conservative if they can get out of it. And then they're going to have free cash flow, do whatever they want, and they'll be very resilient against any shocks in the market. Eric, again, he says, in fear-driven markets, stick to the actual data. U.S. commercial crude oil inventories are very low. That's where that red circle is, and it's declining. We also have global observable oil inventories at very low levels, as low as 2018. And this is daily global gasoline and diesel demand measured to 2019 baselines. The 2019 baseline is this guy here, and we're up above that for diesel, and then we're right around it for gasoline active fleet index. Now, I will say this. You can look at the inventory data, and inventories could lag a liquidity problem. It does depend on what the market participants and the emotions that those market participants have. If everyone gets fearful, everything sells off anyway. That's just the way the markets are. And that can happen irrespective of what the inventories are. Now, the inventories will eventually drive money towards the sector to solve the problem if there's a problem. So you can, some people will say, if you're in such a deficit or whatever it is, why did the price of a certain commodity go down? Well, it's based off of the emotions that people have in the market as well. It's not just the logical data that's behind it. People will sell anything if they get scared. It's just the way it is. You can have markets go down for no explainable reason, and you can't, the data, the fundamentals does not necessarily match the price action, or it doesn't match the emotional feelings of people in the market. So that's there's always going to be that disconnect. There's going to be times where things sell off, uh, and it's unexplainable. And you can even say it's unexplainable during times when the price goes up as well. So it's all based off of fear and emotion, and uh, it's going to happen. Period. It's going to happen. I did a short clip. Check it out, see what happens there. Trying to mess around with things. Here's another one with Michael Oliver. He said, "We've had countless reports lately on the technicals of the bond market, the momentum building for upside, etc. I get that people don't want to fight the trend, but 10-year rates rising 0.1% every single day is a crash. It is unsustainable. The financial system relies on the stability and liquidity of this market in particular. In other words, this isn't the continuation of a trend. It is the capitulation endpoint of a trend. This is why for many months we focused on banks and have recently focused on TLT as a vehicle to trade a rebound. Frankly, anyone still short here, Gross, Ackman, Dalio, Citadel, is looking more and more like a pig about to be slaughtered. Bears and bulls make money, pigs get slaughtered. There's still guys that are short the 10-year yield. The 10-year yield has been increasing dramatically. And what he's saying is, it can't rise that far, that fast forever. We're probably going to have a bounce back, and a lot of people are short. We could have a big bounce back in yields at some point. And that's what Grady was talking about up here, getting that move lower in yields to point number 4. We have a lot of people short here, and we've had yields go up a lot. This is the 20-year yield, and we could see a bounce back in those yields, basically resetting the market to some degree and getting those shorts on the wrong side, squeezing the shorts. Cornerstone Analytics says, in just over 2 decades, global electricity consumption has almost doubled. No matter how much taxpayer money's thrown at wind and solar, they're not a sustainable reality. In 2022, the world consumed 29,165 terawatt hours of electricity, an increase of 13,601 terawatt hours since 2000, an 87% jump. 50% of electricity demand is from the Asia Pacific region, who has seen their demand increase by 239% over that time frame. We've got some massive electricity demand coming ahead of us. And I know a lot of people say, artificial intelligence is the answer. All I'm going to say is this: artificial intelligence is an energy hog. It's gonna eat through a lot of energy. Now, if India and China are in the middle of their S curves for adoption of energy, and they're going to suck down a lot more electricity, but we're going to see a massive boom in electricity demand. Now, how can you play electricity demand? Well, you've got steel, you've got aluminum, You've got all these things that have to be built for the infrastructure for a worldwide electricity boom. We have enough. I don't know. I mean, this is going to be a big boom here, guys. We are going to up our electricity demand worldwide a lot. And that's going to be a big weighing factor on commodities. It's going to be a big commodity boom for electricity consumption. Just power lines, the bases of the power lines, the the wire that they run. I mean, all of it is so much demand. Here's another one talking about the short positions. It says short positions in U.S. Treasuries hit the highest levels ever, and ever is a long time. This is setting the stage for a vicious rally if a waterfall short covering rally occurs. So everyone is positioned on the short side of Treasuries. We could see a rally in the bond market where yields fall, just like Brady was talking about with yields here, this number 4. So he's talking about the shorts really piling it on, and this could reverse very quickly. A short covering rally. This, what could happen is that yield curve could drop, and gold and silver could really take off. Gold, silver, platinum, because of the reversal that could potentially occur in yields and the bond prices. Now, a company's saying, much as I predicted, markets are starting to waterfall. It has a very December 2018 feel to it. Difference is that in 2018, markets got cranky that Jay Powell pushed Fed funds too tight with a bit of excess QT. This time is different. This time, markets are watching the 10-year melt away, and they're starting to panic as the 10s are the collateral for the whole financial system. And there are now hundreds of billions of MTM losses suffered through the collateral stack. Besides, everything funds off the 10-year, so cost of capital is up. Issue is that Jay Powell cannot just tweak Fed funds and fix it. 10s are in a panic because fiscal is running at 8 on the way to teens. Despite the panic, they're still inverted. What can Jay Powell do? If he cuts Fed funds, 10s waterfall as everyone panics that we really are an emerging market. If he does yield curve control, it's even worse as he's printed to fund it, and then Project Zimbabwe begins in earnest. His only real option is to jack the front end a few hundred basis points and wipe out every CUSIP. As others realize that this is the only viable solution, they're going to get scared, really scared. Will Jay Powell administer the medicine? Probably not. I figured we've got a few weeks of waterfalling and then a yield curve control. But the least bad option probably wrecks a lot of guys first. I think it's about to get wild. Jay Powell is finally boxed in. All the options suck, and until someone big is on the ropes, they don't have the political cover to try any of them. Who's excited for a very macro Q4? He's talking about interest rates and how the interest rate market, we're getting scared. Interest rates are moving up on the longer end of the curve. And perhaps Jay Powell is boxed in where whatever decision he makes could cause fear to the markets. That's what he's saying. Yep, did an interview with John, if you guys want to check that out. We've got Camco here, 2004 versus now. I think we may be here. So here's 2004 as it worked its way on up. You can see that we're working our way on up. Will it be as tidy as this? I don't know. But this is from Scott. He's just trying to make a parallel to what potentially could be coming out in the future for uranium. Yep, I was on a panel with Capital Cosm. If you guys want to check that out, gave my opinions there. Rick Santelli, I'm going to skip that one. So here's yields. Here's the dollar. Notice any resemblance between the two? Yes, they're very well correlated. The price of the DXY and the 10-year yield. 10-year yield's on the left, DXY is on the right. Here's gold to silver ratio. This is not the best view for precious metals. Could gold be breaking out against silver? What that is indicating is that we could have fear in the market. Generally, gold outperforms silver during fearful times, and that could be a possibility. Here's another one. Says the last time gold was as oversold as today was in 2018 at $1,200 an ounce. 2 years later, it hit 2,000 an ounce, and talking about the most oversold time since 2018. And we are entering that time frame right now. So it could be a good time to be looking at gold. Now remember, gold does well when those yields drop. And what do we have, guys? We've got everybody piled short against bonds. We've got yields that are probably going to peak here at some point, and that's going to push gold and silver and platinum, I think, to the upside, potentially. And we'll see how it pushes it. It might favor gold over silver, depending on the market conditions and what it looks like. Possibility. So this guy says, don't think there are enough solar panels or wind turbines. Try electric cables. That's what I'm talking about, the electricity growth. Grid investments will have to double every year to 750 billion by 2030 just to stay on track for net zero. We need lots of investment going into the electrical grid. And that, I think, could be playable because everything that we are producing is more electricity out in the future. If we go nuclear, more electricity. We go renewables, more electricity. And we could still use more electricity with fossil fuels. So aluminum, iron ore, and all that is used to build a lot of this stuff. The bases, the transformers, the covers that they put on all these things, big stands that they've got, the bases and the stands. It's all going to be consumed here for electrical power grids. One way you could play it. Sven says Baltic Dry Index is broken out to new highs for 2023. That is in the red there, breaking to the upside. And we know that. We follow that. Every day above 90 is a spectacular day. It goes through about the record cash flows, and I showed you that one chart there. But that's where I'll end it, guys. Give me a thumb up for the content. Subscribe to the channel if you haven't, and subscribe to the website if you'd like. Join our community. We do have a 5 p.m. Mountain Standard Time on Sunday, a question and answer session coming up. So don't forget to put that on your calendar and show up and ask questions if you like, if you're part of the community. And that's what I've got for today, guys. So we'll catch you later. Finding value.